Hi, Norman Hallett here with your next 4-minute drill for traders. Let's continue with what I consider the most important topic to the disciplined trader, and that's the topic of capital preservation in your trading. In the last couple of drills, we talked about keeping your individual trade risk below 2% and keeping your risk in your portfolio of trades to under 8%. Plus, we went through the importance of being patient in choosing your trades to make sure you have enough 3-to-1 and 4-to-1 reward to risk trades to keep your numbers up in that area and the odds in your favor over time. Today, I want to add to the ledger by making sure that you're being realistic about the amount of risk that you're taking in a trade. And by that, I mean I find that traders often underestimate the amount of risk required to properly trade a given market. For instance, don't kid yourself by thinking you're only risking a small amount if you're in a position trade, holding a position overnight, in a highly flying technology stock or a highly leveraged market like coffee or even the S&P these days. I see many traders who go into a trade with the intention of the trade being a day trade, but the position goes so well, they decide to hold it overnight. Well, of course, that changes your risk portfolio dramatically. Holding a position overnight adds considerable risk, as you know. You must first ask yourself, is holding the position overnight what I really want to do? Is it part of my trading plan? And if not, you shouldn't be doing it. Now, if after you offset the position at the end of the day, you're welcome to say to yourself, I would have liked to have held that position. I'm going to find a way to make it part of my trading plan. Then it would be up to you to narrow down the if-thens of holding the position overnight and then back-testing the strategy. And if it proves out, you can add it to your trading plan. But you just don't go holding a position because it's what you feel you should be doing in a situation. And it's not part of your trading plan. Also, going hand in hand with the notion of being realistic about the amount of risk required to properly trade a given market is you need to understand the volatility of the market you're trading and adjust your position size accordingly. That is, take a smaller number of positions in a more volatile stock or the futures market. Also, be aware that volatility is constantly changing as markets heat up and cool off. Okay, that's it for this edition of 4-Minute Drill for Traders. So until next time, stay disciplined.